I want to share with you 3 scary facts about the average American. I want to give a shout out to Alex Hormozy. I saw these facts on really an opening scene in one of his recent videos. And given that we are on the daily financial news, I thought it was worthwhile sharing, discussing, and acknowledging that our average financial education in America is somewhere between horrible and non-existent. So, number 1, did you know? Did you know? And again, these are all according to Alex Hormozy, that a baby, yes, a newborn baby, fresh, 1 day old, 2 days old, a brand new baby has a higher net worth than the average American. How can that be possible? How can that be possible? Well, the answer obviously is debt and credit. The average American, given Alex point number 1, is in debt and has a negative net worth, and frankly doesn't own any assets. They have chosen, or by life's circumstances, I'm not sure who to blame for that. It's got to be a lot of people, right? Education, schools, family, personal accountability, right? Extreme ownership. But again, according to Alex Hormozy, babies have a higher net worth than the average American. All right, point number 2. This is interesting when you step back and look at it in context. The average employee will make 7 figures or more in their career. The average employee will make $1 million or more in their career. Kind of point 2, I'm going to call point 3. If you actually go from average to median, again, we talk about average and median a lot on this channel. The median U.S. wage earner or employee will not make $1 million, will not make $2 million, but will make $3 million or more in their lifetime. So negative net worth, making $1 million to $3 million bucks. We are a consumer nation. We simply are a consumer nation. The consumer is 65, 68% of the economy. We love those little dopamine hits when we buy the latest gadget, gear, or clothes. But at the end of the day, folks, I've tried to share with you repeatedly that the wealth formula is remarkably simple. Step 1, frankly, live below your means. But again, you can do that in 3 different ways. You can, as Olivia and I did, whack expenses. We, over a course of 18 months or so, dropped our expenses 50%. Not fun. I'm sure our friends and family thought we were crazy. I'm sure it was no fun. Number 2, you could get out there and make more income. Whether that is get a new job, make more commission, get a side hustle, whatever it is. Or number 3, which is probably right for both people, or most people, do both. Find a way to lower expenses and increase revenue. Folks, it is not that difficult to understand. And then just to finish up the wealth cycle, number 2, you've got to become an elite investor at something. I do not believe in diversification out of the gate. If you want to become elite at something, you can't become balanced. You must become unbalanced. If you're going to become a great business owner, stock investor, crypto investor, real estate investor, classic cars, trading cards, whatever it is, if you become elite, you'll make it work. And then finally, the reason most consumers who make millions of dollars in their lifetime are broke and have a negative net worth is it's not fun. It takes 10 years. It takes 10 years. The first 5 years suck. It's slow. You're not really seeing the momentum, but trust me, it is there. So another thing I heard yesterday, I don't know where this was from, but I thought it was an interesting discussion, and that is, what is a wealth ratio? All right, got my attention, wealth ratio. Essentially, it is what you earn over what you need. What you earn over what you need. And obviously, the bigger the number, the more financially secure you are. In fact, if you take my course, Get Your Money Right, one of the things that you will understand is what is your wealth ratio. One of the spreadsheets that you will go through is to generate, I didn't call it a wealth ratio, but that's exactly what we did. What do you make versus what you need? Produces a score, puts it on a range, and says, hey, here you are. So again, pretty interesting to understand. And I think it is crazy that a brand new baby has a higher net worth than the average American. Again, shout out Alex Hormozi for one of his recent videos. Well, on that topic, it probably makes sense that we just jump into the key economic number of the day, and that, of course, is retail sales. Once a month, we get to see what the consumer is doing. I think this retail sales number actually, headline looks good. Under the covers, no bueno, not good. So headline, retail sales up 0.7%. Higher than expected. It was expected to go up 0.7%. Headline, retail sales higher than expected. However, we are at that time of year and whatnot, buy automobiles, right? They buy automobiles, big trucks, whatever. Core retail sales, X autos, X gas. What do you get? You actually get you get 0.2. Expectation was 0.4, and last was 0.2. So again, this auto sales. So again, something to think about there. And when you dig under the retail sales even further, you could see that food was down. It was a negative number, down 0.6. Also down at 0.4. Is the consumer numbers? So, take those with a grain of salt. Something else I went out and researched after listening to Alex Hormozi is, what is the median net worth of a renter versus a median net worth of a homeowner? Oh, internet connection is breaking up. I do not know what to do. Thank you. I appreciate that. I do not know what to do. I'm going to keep going and just hope it keeps up. $10,000. Median net worth of a homeowner, $400,000. We've often talked about homeowners and renters, right? The key to wealth is owning assets and the like. So, it is clear as day. This whole "you're going to own nothing and like it" nonsense is complete nonsense. The key to getting wealthy is owning assets, whatever those assets might be. Again, the longer you hold them, the better your chances. Let's go over some data from Mike Simonson at Housing Wire, doing and also his research. This was in a Housing Wire article. Active inventory is up 27%. 10 states have more listings today than 2019. However, there are plenty around the country that are still tight. Midwest and Northeast. Places like Chicago and New England are still very tight and below 2019. Mike Simonson is calling for a 15% pop in inventory, so inventory will build all of 2025. Listings are falling right now, not to be unexpected. It often happens seasonally. In fact, Mike says we probably won't see any listing boost until February, again, spring selling season. Mike talks about a big recession in 2025 will not create meaningful inventory until 2026. Again, Mike is very gracious and nice, kind of pointing at the crash bros, saying you guys do not understand what's going on. If there is a big and nasty recession, the housing market does not move as fast as they want. So any impact from a big, deep, and nasty recession will not be really felt in the housing market in any meaningful way until 2026. Guys, if you remember my conversation with Melody Wright from a week or two ago, that was essentially where we disagreed. Melody was essentially calling for some things to happen in very quick order, impacting 2025, aka bloodbath. And my discussion with her was, yes, I could see what you're talking about, but I don't think the market moves that fast. That was essentially our disagreement. Housing Wire is forecasting, Mike Simonson is forecasting an increase of 3.5% for 2025. I'll call my housing forecast a little bit below that, call it 2%. I just saw somebody said they woke up crying today. Not sure why you woke up crying today, but I hope everything is okay. Yes, I do read some of the comments. And did I just see somebody say Pace is close to a billionaire? Are we talking about Pace Morby being close to a billionaire? Really? I haven't heard that. Anyways, sorry. I got distracted by the comments. What else do I got here? Oh, let's talk about Atlanta. I want to talk about Atlanta. I don't know if you know this. I read this in a couple of articles, so let's just assume it's true. In Atlanta, 25% of the rentals are owned by the big, nasty corporate, build to rent folks. So let's just think about Atlanta. Let's just try to paint a picture. Let's just say there's 1 million units in Atlanta, all housing units. Let's assume that, gosh, I don't know, what's a right ratio? Let's call it 100 grand are rentals, right? So the other 900 are second homes or owner occupied. So we're really talking about 1 million or 100 grand. And then in Atlanta, which is the most distorted market, that's why this is an interesting brain teaser, 20 corporate lawyer or corporate, Wall Street, leaving 75% owned by mom and pop. Again, Atlanta is the market where the big boys play the most. So now let's just have an interesting, and I haven't done this, like these are all live, so we're doing this live together. Let's assume that the big boys in Atlanta are seeing, I don't know, vacancies and longer lead times and all of that. What will the big boys do if Atlanta cracks, if the Atlanta housing market cracks? I think it's going to really depend on how this stuff is financed, right? Because I think a lot of them bought this inventory with a debt structure that really makes it pretty easy to cash flow, right? These units were not bought in the last year with 7 and 8% mortgages. These were bought over the last 5 years at 3, 4, and 5%. So I think their debt structure is okay, but who knows? They're also probably sitting on a bunch of equity, right? So there are probably some units in Atlanta that a slower market would allow them to exit, right? I think that makes sense. So when I look at Atlanta and I look at 25% the big boys, 75% mom and pop, and a market that could potentially crack, what happens? Well, I think the big boys move first and move aggressive. What does that mean? Well, I think the big boys, given that they have a disproportionate amount of units, and again, remember the problem with the big boys is they're very concentrated. A build for rent community might have 100, 200, 300 units in it. So if that community is underperforming, they got a real problem. Mom and pop's got one here and one here and one here, and not nearly have the concentration risk. So I'm left to think that the big boys could be slashing rents, doing move-in specials to up occupancy. I certainly think that will have some implication on mom and pop, likely softening rent, making it turnover probably more frequent. But then I go to home prices. The question for me on home prices is, who is going to buy this stuff? Think about a build for rent community. Let's just say it's got 250 homes in it. and there's one owner. Do you realistically think they're going to piecemeal sell the 250 homes to owner occupants? I don't. I really don't. I don't see that coming. I don't even see them selling the 250 homes to mom and pop investors. It doesn't make sense. If you're a hedge fund or Wall Street fund and you own a community of 250 homes that's underperforming, your only option, my opinion, I just don't see any other way around it. There are some folks talking about Atlanta, talking about the 25% concentration as going to be, and I agree, it could happen if they sold off the homes one at a time. But I don't sit here with any kind of community. To be one big Wall Street firm selling it to another big Wall Street firm, and there's going to be no price discovery. It's not going to impact single family homes, in my opinion. So I don't know. I do want to highlight two really fun videos that went out yesterday. I want to shout out Brandon, who's part of our school community. He came back on and talked about infill build for rent, right? Talked about build for rent for the mom and pop investors. Buy a lot for less than 15 grand. You have the plans, build it for 220, get a loan at 300 or get a value of 300. Lots of great value in there. Build for rent might be something that you could do on a local level. Also, I want to shout out Dave and Morgan, who came on and talked about sober living, right? Talked about, living in New York, I think it was, and buying some sober living houses out in Florida. That was a very interesting conversation. Again, I loved sharing with you new faces and new names and new stories. You can find both of those videos went live yesterday, one at noon and one at 5. All righty, folks, don't forget our event in Vegas is coming up. It's less than 60 days away. It's time to stop messing around. It's time to stop saying you're coming. It's time to buy your tickets. You can go to Eventbrite and get your tickets. Just look up One Rental at a Time. I'll try to post the link below, but sometimes YouTube deletes the links. I hope to see you guys in Vegas with all of our amazing millionaires. Take care. Have fun. Later.